Hello, I'm Devin Banerjee, and welcome to a special edition of LinkedIn News Live, where the business conversation, as always, begins with you. It's Tuesday, February 2nd, and we're talking the GameStop Mania. How a Reddit forum turned a struggling video game retailer into a company with, just a few days ago, a market value of $30 billion, on paper anyway. Some of the hedge funds that shorted the stock and others like AMC Entertainment were completely undermined. One of them, Melvin Capital, needed a $2.75 billion emergency infusion to cover its losses for betting against GameStop. So is this closer to a Ponzi scheme or a tale of populist morality? Joining us now to discuss that and more is Kevin O'Leary. He's chairman of O'Leary Financial Group. Kevin, welcome to LinkedIn News Live.
Great to be here. Thank you so much.
It's great to see you again. Kevin, a couple days ago on LinkedIn, you wrote that you have never seen anything like this before. On the whole, Kevin, do you see this as a positive or a negative development?
I see it overall as a positive, and let me explain why. It is true, and I've been in the financial markets for decades and never, ever have seen anything like this. Let me explain why I think this could end up being a good thing. You know, in America, we have 100 million people that have no plans for their retirement. They have no funds set aside. It's an extraordinary situation, primarily brought forward because for decades now, we have not put financial literacy into the curriculum of high schools or colleges even. And just the basics of credit cards and how to invest and buy a stock, et cetera. And so we find ourselves in this rather unusual situation where you have a whole segment, almost a third of the population, completely unknowledgeable about what to do. Now, what actually happened here, the genesis of this extraordinary force, if you want to call it that, is that people that have $1,000 to invest or $200 are not of interest to money center banks. They're not of interest to online brokers because they're unprofitable accounts. And so those 100 million people are ignored. Then along comes this platform called Robinhood that says, we are here for you. We don't care if you have $50 or you have $200 or $5,000, whatever you have, we're going to democratize investing. This is about 36 months ago when this phenomenon started to occur. Now, everybody wrote them off saying, this is ridiculous. It's not going to work. There's no way to make money. And a matter of a few months later, they have 16 million accounts, 16 million. Now, nobody understood the power of that at the time, but they started buying and selling stocks. Whether you agree with them or not is a different issue. But there's that vertical. Let's just take that group. Then at the same time developing was this WeBet, you know, this whole Reddit crowd on that were focusing on trading stocks. They were two independent entities, okay? Wall Street Bets had nothing to do with what was going on at Robinhood.
Yeah.
But then this extraordinary occurrence, all of a sudden, and if you actually go back and read the blogs and read the conversations going on in Wall Street Bets, these are not stupid people. They may be young, but they're not stupid. Lots of engineers there, lots of people that understood what it means when the float of a stock becomes more than 50% short. They get it. They put two and two together and they start picking these situations where companies had disclosed that their float is 50% or a hedge fund disclosed it. And they quietly teamed up with their counterparts just by social media and said, let's go get them. Now, nobody anticipated this outcome, but within a matter of the first few thousand trades, it became clear that the volumes were picking up. Because I went back and looked at the trade volume. I have all that data available to me. Because I'm in O-Shares and I have a platform that I'm a regulated provider of indexes and ETFs in O-Shares. I saw something incredible. On Thursday, last Thursday, the volumes for just GameStop, just stay on that one, not AMC, just GameStop. GameStop had, the stock was trading at around $300, up above, down below to $290, whatever it was. But the dollar volumes were not retail. They were institutional. It was billions of dollars trading. And so all of a sudden you had these climatic forces of, you know, short covering at the hedge fund level. My guess, the losses are close to $5 billion. That's just a guess of what we're sitting with here, because that's more than the market cap of the whole company.
Yeah,
Once,
absolutely. And let's get into that a little bit more, Kevin. So you're saying this is a positive development because so many of these investors who are not dumb, as you said, but they're learning very quickly about how the market works and how the market functions. We're now seeing, just looking forward as people kind of catch their breath in this whole saga, Kevin, we're seeing ideas being floated about reforms, a transaction tax on high frequency trading or ending the payment for order flow model of the brokerages. I mean, do you think there should be any reforms?
no, none at all. Simply continue to shine transparency on open positions in both long and shorts and let the market be the market. I mean, that dialogue's been going on all week and it's even continuing to. When I knew this was completely, extraordinary, started Saturday morning at around 10 o'clock when my social media, including LinkedIn, but certainly on Instagram and Twitter, exploded with this issue. It exploded. I started getting thousands of messages about this on both sides of the debate. Now, I've never seen that happen before either, but clearly the market was splitting into two sides saying we've got to regulate this out of existence, which is ridiculous because you can't do that. You have to understand something that's paramount to successful capital markets, leaving out this issue of GameStop. Forget about GameStop for a second. For some people, investing means a millisecond. That's a high frequency trader. For other people, it means holding a stock for a decade. We need to accommodate both in financial markets. We want the liquidity. We want the long-term investor. We want inclusiveness for every age group and every kind of investor, whether you're long and short. The last thing we need are politicians who always take an opportunity. I don't want to be critical here, but anytime there's a crisis, they love to get airtime saying we're for the little guy, except in this extraordinary situation, the little guy has gained the power in a way they've never had before. So they're really confused about this, but the answer is no need for regulation, just more transparency, and we're going to get that and let the markets be the market. And I am just thrilled in terms of what's happening with those 100 million people that are now being serviced by an entity that's being sued, being hassled by politicians, being beaten up every day. I'm a champion for what they've done over at Robinhood. I believe in their mission, and I'm proud to see it happen.
I want to take a second to welcome some people joining us in the stream. We have Dolores from Texas, Andrea from Florida, Tracy from Ireland. Thank you, Tracy. William from New Jersey, Ignacio from Texas. I also want to pull up a poll just to let our viewers know we've been polling professionals on the LinkedIn news page, and we also want to hear from you. Should small investors or individual investors be able to trade just like the hedge funds and the big institutions can? Let us know in your comments on this stream as well. We have Kevin with us, and we will also pose your questions to him during this time. Kevin, we do have a question coming in already from Caroline, who's saying, Caroline is hearing that people are spending some of their stimulus checks on this GameStop trade, some money that they may be, and of course everyone's situation is different, but they may be, that money may be needed elsewhere. Do you think that's too risky for consumers using their stimulus checks right now?
Well, I think there's been a lot of confusion about what we're doing with this whole COVID program and the PPP loans that started in April last year. What I've come to the conclusion of having seen the outcome of the first stimulus package is we should stop giving businesses money. No more bailout. We don't need to. There's enough liquidity in the market for those that are going to survive to get capital. What I would prefer to focus on are not people that are already employed, making an average in America of $56,000. We should focus on two things, the stimulus, which is an answer to this question. To find those that are unemployed and have been displaced by the pandemic, let's give them full support during the next 14 months. Those unemployed people that need to find new jobs. That's number one. And number two, any capital required to provide the logistics to get the population vaccinated. Those are the only two things we need to do. So I am not a fan of sending stimulus checks out to people that already have money and are already working so they can trade the markets. That is not the purpose of what we're doing. That should have gone to somebody who is trying to pay their rent, take care of their kids, stay, with a roof over their head and has no job. That's what we as a society should be doing, is taking care of them, not bailing out airlines and movie theaters and businesses that are going to go bankrupt anyways. That's stupid. That's a really bad use of capital. It's vaccines and people. That's it. And so my answer to that question is that's a horrible thing to hear, that a stimulus check went into the market. That makes no sense whatsoever.
Yeah. Kevin, as you said, the conversation on your social platforms, including on LinkedIn, has just been very, very robust. I want to pull up a quote from one of our LinkedIn members, Barbara Gray of Grady Capital Research. She says the following. She says, this attack is similar to the Occupy Wall Street movement that took place a decade ago, arising out of the 2008 financial crisis, except that it's taking place in the digital, not the physical world. Social media once again serves as this disruptive force. Kevin, focusing on that Occupy Wall Street theme, though, do you see this as a continuation of Occupy Wall Street? And is it kind of the investor's version of Main Street versus Wall Street?
Well, there is a vigilante tone to the way the media is talking about what actually happened. But if you talk to the actual traders, which I've done, I'm fortunate enough to know enough of them, and ask them, what was your motivation to do what you did in terms of going long GameStop stock? And they said, well, it was a calculated bet that the shorts would be squeezed, and I could, for some some period of time, take advantage of that and force them to cover and profit from it. It wasn't really, let's go get the man or let's go beat them up like they were in the occupation times of Wall Street. It's a different tone. These are savvy investors. Yes, they're young, but they're not stupid, as the hedge funds have just found out. And now, as a result of this, and I think this is the point that is the most important, particularly for this question, is there is a new risk in the market, and it's this. If you go naked short, which is illegal in some cases, or you borrow the float, which is legal, and you start paying a VIG on it as much as 40% interest to borrow it, and you expose yourself by having to disclose, which you do, that you're short that stock, particularly if you're past 5% of the float, you have the risk of these investors, because that's what they are, focusing on you, pinpointing you, and squeezing you out of your position. And that risk has never existed until last week in this way. Because the traditional model, and I want you to think about this, it was always this way. Large hedge fund that has a lot of notoriety quietly shorts a stock. Then they issue extremely negative research on the reasons that they shorted the stock. Then they go on to cable news, sometimes globally, and talk about why they're right on their short. And they let everybody know after they've shorted, and they're using their bully pulpit to do that. That was the traditional model. Now there's a new sheriff in town. It's the individual investor with a little candle, except there's millions of them, and they listen to that person do that, and they say, oh, that's interesting. Why don't I go long that position? Buy the millions and see what happens. So I wouldn't be going out as a hedge fund manager anymore on a bully pulpit on cable news, boasting about my research on my short position, because you have a new sheriff in town that could put you in jail in a horrible way. And that is a new risk in the market that we've never had before. And I call that democracy. I like it.
Yeah, that's a great point, Kevin. And actually, Luke in our stream says what occurred was not a result of fundamentals within GameStop, of course, but within the funds that were short the stock and that short squeeze dynamic that you just mentioned. And so, Kevin, as we talked about a few minutes ago, this movement has really been organized and carried out online, with social media playing that fundamental role. We also see the online influence of folks like Elon Musk, for example, literally moving markets with their tweets. I'm curious, Kevin, if you think there should be any measure. I think I know your answer to this question, but should there be measures in place, some kind of measures to prevent a single player from moving markets with just single tweets?
No. We just need transparency. Elon Musk is totally transparent with what he's saying. It's right out there to look at. In fact, I don't like canceling people's accounts. I think democracy has to take everybody and listen to them, and individuals make decisions on whether they think it's right or wrong. But the whole idea of having an idea of exchange ideas, is very, very important, even if you don't agree with that person's ideas. Now, I don't like, slander and hate and all that stuff. But frankly, when it comes to, let's just take Twitter, where often these ideas are put forward, I think it's fair, because it's a private business, to say to any individual, I don't care if they're president or just somebody saying things that are hateful, you can't do that anymore. We're going to start monitoring every single one of your tweets. And if you do this 3 times in a row, we're going to ban you or we're going to shut you down. But at least give them a chance to modify their behavior. Because if you have 80 million followers, 50 million followers, or whatever it is, the company can afford to put 2 or 3 editors on you and watch what you do. And I think that would have been a better treatment for what has occurred to people that have been canceled on social media. I really believe in free speech, even though it's an uncomfortable thing. You always have the lunatic fringe. That's the price you pay for free speech. There's always somebody that's saying something you don't agree with. It's the dialogue that matters. It's the idea exchange that matters. And we don't want to give that up in our society. The same for our capital markets. We must embrace everybody, the short sellers, the micro traders, the long traders, the young traders, the old traders. That's what makes our markets so incredibly efficient and so good. And so anytime you hear a politician saying, let's shut this down or shut that down or shut this down, you don't know the unintended consequences. You must fight that and keep everything open and transparent.
Yeah, it'll certainly be interesting to see what comes out of some of these hearings and conversations happening among our regulators. I want to take another moment to say hi to some folks joining us in the stream. Desroy from Jamaica, Elnora from Florida, Matthew from Colorado. Thanks so much for joining us. Kevin, a question from Matthew in the stream, which is, should some of these hedge funds look to the Reddit or the individual traders as an opportunity to bring their perspective into the fold, maybe to bring them into professional investment operations?
That is a great question, because Saturday morning from probably 8:30 in the morning till probably 2 in the afternoon, I was inundated with phone calls from people saying, tell me about Reddit. Who are these people? Where can I hire one? all the financial services companies that I do business with that have caught with their pants down on this. I said, why don't you start by hiring somebody that's under 30 years old? Why don't you start there? Like, anybody knows who these guys are that are hip to social media, and you just were ignoring it. And now you want to hire them. And now there's all kinds of hedge funds talking about a strategy. They want to go raise money by infiltrating the Reddit crowd. Those guys are really smart. That's not going to happen to them. They are very, very hip to what's going on. And so if you really want to understand this movement, you have to understand the motivation. They're not raging against the machine. They're taking advantage of you because you're short, and they're profiting from you because you were so arrogant to think they didn't matter. That's exactly what happened. And that won't happen again. I can guarantee you short sellers are going to seriously consider the risk they have from the social media, let's call them vigilantes. Just like in the old days where there were bond vigilantes, now you've got short vigilantes they're not doing it because they're mad at you. They're doing it because you left yourself exposed, and they can profit from that situation. And that, my friend, is a definition of the market.
Kevin, I want to bring up another quote that we've seen on LinkedIn from someone you may know. He's Mohammed El Arian. And on LinkedIn recently, he said the following: this is not just an epic David versus Goliath story that's, of course, attracted worldwide attention. Potentially in play is, as you said, Kevin, the democratization of finance, tech-led disruptions to market hierarchy, the overall valuation of markets, the regulatory responses that we just touched on, and the market structure itself. Kevin, what do you see as some of the long-lasting effects coming out of this, especially as it relates to that tech-led disruption of the financial system?
Well, I think what's interesting is the risk we just talked about, that now when you're naked short or you're short and your position is exposed to the overall market, and certainly those that are using social media to hunt you out, you have a new risk. That's going to change behavior, number one. Number two, there seems to be a huge opportunity to solve a problem that we've had, a systemic problem in society for the last 30 years, the fact that 100 million people do not have an investment account. Saving money into a bank account is not the same as investing, because there's no interest anymore. And so we've got people that are making an average salary of $56,000 that are becoming part of the troop we're talking about, that are learning the day trading, for example, on Robinhood. But Robinhood has a huge opportunity here. Instead of just day trading, and there's nothing wrong with it, people do it for various reasons, particularly when they're cooped up as a result of a pandemic. But if they were to take 10% of their savings and put it aside, and the good news is there are dozens of apps in the market now that are simply can get for free on your phone that do exactly that, that take a $50 or $100 contribution and give it tremendous diversity through a advisor, basically, that puts you into multiple exchange traded funds. Very low cost, very transparent. But instead of day trading, you're actually putting something aside for your retirement. Now, this to me became obvious about 24 months ago when I realized, wait a second, why am I not part of this revolution for financial literacy? And I, in fact, I'm doing that with an app called Beanstocks, which is one that I've tried to help design for people that's incredibly easy to use. And you don't have to use Beanstocks, you can use anything. But Beanstocks has made it really easy. It's not a day trading anything. I have $50 to put to work, and it does that, and it lets you do it on your phone. So I'm trying to get young people to say, look, day trade all day if you want, but take 10% of what you make. And I tell this to my kids, I tell all the people I visit in high schools and now the virtual meetings we do, start to invest for yourself. Because yes, you've learned this remarkable thing because of Robinhood. Now take advantage of what you've learned and start thinking about the difference between day trading and investing for your retirement. Because if you only put $100 a week aside and you're in your 20s, you'll end up with $1.5 million if the markets give you 6 to 8% as they have done for 100 years. And there's a lot of us in this space. I'm proud to be part of this movement. I'm proud of all the apps that do this, but that's how you get to those people, because the banks haven't got to them. The brokerage line traders haven't got them because they don't want them. They can't make any money off $200. But the rest of us should help them. And that could be the great outcome of this huge thing that happened this week. The focus on this, and again, I go to my social media and just look at all the platforms. I mean, I have never, ever, ever seen anything like this, and I'm proud to be part of it.
It's a fantastic point, Kevin, that literacy and education, I don't think anyone would argue that we need more of those things. It's always important. And sometimes there's a catalyst like this past week that just shines a light on the importance of it. Kevin, let's pivot a little bit. You are an investor in and an advisor to dozens of businesses. I want to ask you about your outlook for them over the next 12 to 24 months. Do you think this bifurcation that we're seeing in the economy and in businesses will continue? And are you seeing that in your own portfolio?
Yeah, I have to tell you how there's no other word other than stunned, the outcome that I've seen since March. And I'll explain it very simply. Prior to the pandemic, we had positions in 57 or 58 companies. We now have 36 that have survived the pandemic. The ones that failed were in the industries that have changed probably forever. The wedding industry, for example, cruise lines, for example, movie theaters is another, food services for sports stadiums. We had many companies involved in the multi-billion-dollar wedding industry. There hasn't been a wedding with 200 people since March 7th. I mean, there's so much change going on in the economy. But here's the amazing part of it. And the best, I'll keep it simple because it really does apply to the whole S&P 500 and globally as well. So in March 7th, and the way you manage a portfolio that size is you get data, because there's no share price on a private company. We have companies in almost every state, from gym equipment through to greeting cards to insecticides to technology companies, all kinds. We look at two numbers each week. We get other data, but we really care about these two numbers: revenue and free cash flow, because we manage a business based on its discounted free cash flow. When you're private, cash flow matters. And so each week we see what's going on across the portfolio. And then along comes March 7th. By the third week in March, I saw something I'd never seen before. Every single company had gone negative cash flow. Why? Because we shut down retail in America. If you look at American revenue for private businesses, look at the pie chart. 50% comes from retail, your Targets, your Walmarts, your Bed Bath & Beyonds, all those. 40% comes from Amazon, which has become a giant retailer. And when you sell through Walmart, you make 50 cents on the dollar. When you sell through Amazon, you make 60 cents on the dollar. And then the last 10% prior to the pandemic was direct to consumer on a platform like a Shopify, which nobody really knew about back then, pre-pandemic, but that's 100 cents on the dollar. Go fast forward to today. We're in the middle or the beginning of Q1. I have the budgets for Q2 now. The companies that made it are actually ahead of free cash flow. How did they do it? What happened? They should have gone out of business. What occurred in April and May, and I'll give you a very simple example. Take something like, take a greeting card. This is a greeting card. That's a three-dimensional greeting card. It's a company called Love Pop out of Boston, one of my companies. You do not buy greeting cards online. You buy them in retail. It's an emotional a purchase. We have stores in every mall in America, every train station, whatever. We make these in Vietnam, CAD designed, digitally cut with lasers, brought back to the United States in a store. Imagine what happened to our business right around Mother's Day when all the stores closed. We even had a store in Hudson Yards, the most expensive retail space in America, that you can't pay more per square foot, shut down. And then a woman at her CAD station tried to order some flowers in Boston. It's headquartered in Boston. And all of the flowers in America, a lot of people don't know this, come through where I am here in Miami from South America to cold warehouses all across the country and are delivered to people. They all were rotting near Mother's Day. So she went home and wanted to send her mother some flowers. Couldn't send her a card, obviously, because couldn't buy one at the time, even though she was working at the company. She designed this. A bunch of flowers. It's not a greeting card, it's flowers. Digital, sent to Vietnam, cut, $29.95. The company started offering them direct on the Shopify platform to consumers across the country. And all of a sudden, the groundswell direct to consumer started. That company is ahead of free cash flow now because they've developed this giant platform direct to consumer. At the same time, and I'm talking about the entire economy now, let's talk about the whole S&P 500. Think about this. An optimized company in America that's private makes 15% pre-tax, does 100 million in sales, 15%, 11 million free cash after tax. I've got plenty of those. That's optimized. That's a really well-running company. What have we discovered since the pandemic? That the people working in accounting, now this is very relevant to LinkedIn, because this is where I learned a lot of this data, okay? Because I was listening to my own employees and what was happening. Accounting, compliance, and logistics departments. Those are the people that sit in cubicles in most headquarters in states, in my nexus, are in New York State, Florida, Texas, and California. All of a sudden, they're coming back to me and our HR people saying, we have been working from home, raising our kids, taking care of our elderly parents, and not driving into HQs anymore. We do not want to return. I'm not talking about all the employees. I'm talking about 15% of them, okay? So all of a sudden, I need 12% less space in that office tower in Boston, New York, Miami, Detroit, wherever it is. And so I'm starting to negotiate with our landlords. But it doesn't stop there. This is what the unintended consequence of forcing working from everywhere remotely did to the S&P. Here's another example. Here's a company, another one of my companies.
I want to jump in real quick, and these company examples are fantastic, but I just want to get a sense, is the lesson from 2020, you think, that pivoting is just a key quality of these small business owners and these leadership teams, the ability to pivot in such difficult circumstances?
But it's not just for small companies. I'll give you the example. I was about to show you one that sells oxygen in retail. And all of a sudden they exploded in sales. This is not a small company. And the world's largest retailer called them and said, look, we want you to give us a planogram for a rollout in every store. Now, normally that company, and I would have gone because I'm a large shareholder, would have flown to Bentonville, would have met with the buyer, would have given a presentation digitally. But the buyer said to us, we're not doing meetings like that anymore. You can't come here because of COVID. We're going to give you 18 minutes on a Zoom call. You're going to give us a presentation digitally with video, show us the planogram, show us the idea. When that meeting was over, and I'm proud to say it was very successful, I asked my bean counter, who now is one of the people that never came back to HQ, who's now starting a farm, and he's working. He's happy to do that. This is happening all over America. We saved $37,000 right to the bottom line. And now I know across my portfolio, and indeed the S&P 500 is achieving the same thing, we're cutting business travel budgets from 20 to 50%. Now our portfolio has the potential, the 36 companies that did the digital pivot you just referenced, instead of making 15% pre-tax in Q2 this year, we think we can make 18%, 300 basis points more free cash flow as a result of reducing rent and reducing business travel. That's not just me. Look at Nike's numbers. They basically achieved in 5 months what they thought would take 6 years. They're almost at 50% direct to consumer, full 100% gross margin sales all around the world. That's a digital pivot. Same thing right up the S&P 500. So I don't want to sound giddy excited about the outcome of a pandemic, which has caused so much human suffering. But if this thing had a digital, silver lining, I just told you what it was. America 2.0 is going to be a very powerful, higher gross margin, more productive, direct to consumer like we've never seen before. I am not opening up any more marginal stores in third grade locations in strip malls in Amarillo, Texas, and Chattanooga, Tennessee. Never opening those again. They're going to remain fallow because I can basically sell direct to consumer. I've proven I can do it. And I'm not the only person doing this.
Yeah, we've seen this across industries. You're absolutely right, Kevin. I want to jump in and ask, what about some personal advice for entrepreneurs or the owners and leadership of your businesses, just as they're going through, emotionally and personally such a difficult time while trying to make these pivots that you're talking about? What advice have you given them personally?
Well, I have data for that too. I can share what worked and what didn't across. This is not academic research. This is real data. Here's what we learned in the last year. Number one, I used to say to people that were considering taking college debt that you should consider 3 careers: engineering, engineering, and engineering, and everything else, forget about it. I don't feel that way anymore. The number one increase in expenditure for me across my portfolio now is to artists, to videographers, to editors, to animators, to story writers, to copy editors. Unbelievable demand for those services. Why? Because the economy is digitizing. Whether you're doing it for Nike, whether you're doing it for me, we need talent and artists that can tell a story about a product so the people that see it online can understand what it does for them. This is paramount. This is huge. So I would argue that in your business, if you want to make this digital pivot, learn how to tell a story about your product in 29 seconds or 59 seconds or 2 minutes and 19 seconds, because, including on the LinkedIn platform, these stories are really important because that's how people learn about products and services, and they learn about what it takes to do the digital pivot. And secondly, and this is very, very important, we learned that managers, and in our case, it was predominantly women, when we looked at the companies that were successful versus the ones that failed on just free cash flow estimates, when you set goals that your team can achieve over 90% of the time, even though you're reducing that goal, when the team hits the goal working remotely or even working together in some cases, the culture changes and becomes very sticky. And why would it in any way manifest from cash flow, better cash flow outcomes? Even though you're setting goals and reducing growth estimates, the companies that did that achieved higher cash flow. Why? Here's how it happened. We did a lot of digging into this. When the team, even though it's working remotely, and we think from now on 15% will remain remote, feels that they're part of a team that hit the target, the culture changed. There was virtually no staff turnover, even though they weren't working in the office anymore. So for me now, and we discovered this on the women-run companies we had, the ones, because they were very savvy, very hip to reducing their risk of turnover during a period. It was very hard to rehire because you couldn't really meet with people.
Yeah.
It was very hard to do that.
I'm sure I heard that number correctly, Kevin. You said 15% or 50% you estimate will continue working?
No, 15% will not return to the office after the pandemic is over. That's my guess. I think some companies are targeting 20%. I know that it's extraordinary, but it is going to happen. And when that occurs, you want to keep those people locked into your culture. And you do that by setting goals you can achieve. And so that's what we've learned. So we've set a new metric in our portfolios. Learn from the managers that delivered such fantastic results in times of very high stress during the pandemic, and they set goals that were achievable. And we're putting that across our portfolio now, where we're in a control position either through debt or equity. We're setting targets that are achievable because we think in this new world, this digital 2.0, team goal and target reaching and achieving is very, very important. And I think you're going to find this come into the culture, particularly in the LinkedIn aspect of it. You're going to see large companies do this. You're going to see small companies do it. You're seeing it already in Silicon Valley and in Boston. The tech companies are beginning to realize we're going to work in a different world, and we're going to have very, very sticky teams. And, it's happening everywhere, but I saw it, happen in my own portfolio in front of my own eyes.
Lots of interesting data, Kevin, and lots of trends to keep track of. And hopefully we can touch base in a couple of months from now to see where they stand. I want to thank you. Our viewers want to thank you. We've had so many questions in the stream and so many thanks for your time today. And I want to thank you, Kevin, for joining us.
I appreciate it. And I'm just very optimistic after coming through what we went through. great to see you guys again, but I am very, very bullish on America 2.0, and it's coming to probably in the fourth quarter of this year. We've just got to get 66% of the population inoculated, and then we're going to have an economy like you've never seen.
That's great to hear. Kevin, thanks again.
Take care. Bye-bye.
Take care, Kevin. That was Kevin O'Leary, chairman of O'Leary Financial Group. You know him as the Shark Tank investor and entrepreneur as well. Let's take a quick look at those poll results I mentioned at the top of the show. We asked you, should smaller investors be able to trade like the hedge funds and the professional investors do? 90% of the respondents said yes. We have Keith saying smaller investors are affected one way or another, so they should have a seat at the table and be able to participate. 8% of our viewers said no, 2% said it depends. Don't forget to join us tomorrow. My colleague Caroline Fairchild will be speaking with Kathy Polinsky of Shopify on making STEM and engineering more inclusive. I'm Devin Banerjee. Thank you again for joining us on this special edition of LinkedIn News Live.